All right, welcome everyone. We love diving deep into these topics, and this one, business finance. Well, you guys sent in some seriously interesting notes.
Yeah, I was impressed. Some great questions about core concepts, and I think we've got a really engaging discussion ahead of us.
For sure. Debt, equity, leasing, limited liability, mortgages. These are things we hear all the time, but maybe don't always, fully grasp.
Absolutely. And they're all interconnected, too. It's not just textbook definitions. It's about seeing how they work together.
Exactly. Like think about Tesla building those massive gigafactories.
Yeah.
Or how 7-Eleven seems to be on every corner.
Right. These are all strategic decisions, often driven by smart financial moves using these very concepts.
So let's start with, I guess, the most basic one. Debt. Everyone's familiar with it, right? You borrow money, you got to pay it back, usually with some interest added on top.
Yeah, it's like that personal loan you might take for a car or maybe a home renovation.
Right. But how does this work when we're talking about huge amounts of money? Like when Tesla needs billions to build a factory.
Well, that's when things like bonds come into play.
Bonds?
Yeah. Essentially, they're debt securities that companies sell to investors. It's like, investors are lending money to the company.
Okay, I'm following.
And in return, they get regular interest payments, plus the original amount they lent back at a set date.
So for investors, it's kind of like a pretty predictable way to earn some money.
Exactly. Bonds are often seen as less risky compared to, say, investing in the stock market.
So it makes sense for companies to use debt when they need big bucks, right?
Yep.
But why wouldn't they always choose this route? There's got to be some downsides.
Oh, for sure. Like, remember those regular interest payments? Those are mandatory, regardless of how the business is doing.
Oh, I see. So even if things are tough, they're still on the hook for those payments.
Exactly. And if a company takes on too much debt, it can make them look risky to future investors.
That makes sense. It's a bit of a balancing act then.
Definitely. You got to be strategic about how much debt you take on.
So let's shift gears a bit and talk about equity. In your notes, you mentioned being fascinated by the story of Facebook's early days.
Oh, yeah. That's a classic example of equity financing in action.
So what exactly is equity?
Well, it's basically the funds contributed by the owners of the company.
Okay, so in Facebook's case, that would be Mark Zuckerberg and the co-founders.
Exactly. They use their own money, their equity, to start the whole thing. And then, as they needed more cash to grow, they looked for outside investors.
Right, those famous angel investors everyone talks about.
Those investors provide funding, but in return, they get ownership shares in the company. So it's like trading a piece of the pie for the money to bake a bigger pie, if you will.
I like that analogy. So unlike debt, you're not obligated to repay with interest, but you are giving up some control and potential profits.
Exactly. It's a trade-off. Some entrepreneurs are comfortable with debt. Others really value keeping a larger chunk of ownership.
Right. It's like choosing your own adventure, different paths, different outcomes.
And different levels of risk tolerance. Some people are more comfortable giving up a little control if it means faster growth.
Okay, that leads us to another interesting concept, and one that's super relatable. Leasing. We lease cars, apartments, all sorts of things. But how does this apply to businesses?
Oh, leasing is huge in the business world. Like, imagine 7-Eleven buying every single one of their store locations. That'd be a massive upfront cost.
Yeah, makes sense.
So instead, they often lease the properties. That frees up their capital to spend on other things, like stocking the shelves or marketing.
So it's all about having access to the asset without the full burden of owning it.
Precisely. Plus, it gives businesses more flexibility. Say a better location opens up down the street, they're not tied down to a property they own.
I see. But doesn't owning something build long-term value?
Sure, it can, but for things that lose value quickly, like cars or tech equipment, leasing can be a better option.
Makes sense. It's like that age-old question, rent or buy. It really depends on your individual circumstances and goals.
Absolutely. Now let's jump into something a little more complex. Limited liability. This one often gets bogged down in legal jargon, but it's actually pretty straightforward.
Yeah, when I saw that in the notes, I was hoping you could break it down for us.
No problem. It basically protects business owners from personal financial ruin if the company hits a rough patch.
Okay, so if, say, a company like BHP has massive debts or gets sued, the owners aren't personally on the hook for everything.
Exactly. Shareholders are only liable for the amount they invested. Their personal assets are safe.
Wow, that's a huge relief, I bet. So this must encourage people to invest more, right?
For sure. Limited liability is a cornerstone of modern business. It allows for more risk-taking, which leads to more innovation and growth.
It's amazing how something seemingly technical can have such a big impact on the whole economy.
That's the beauty of business finance. It's all connected.
All right, last but not least, let's talk mortgages. I always think of houses when I hear that word.
Me too. But they're also super important for businesses, especially those that need a physical space to operate.
Oh yeah, like retail stores or restaurants.
Exactly. Think of, say, West Farmers, the company that owns Bunnings. They use mortgages to finance the purchase of those massive properties.
So instead of paying the full price up front, they take out a loan, just like buying a house.
You got it. And just like with any loan, there's interest involved.
Right. Got to factor that into the cost of doing business.
Absolutely. Responsible mortgage management is key, whether you're an individual or a huge corporation.
Wow, today has been a whirlwind tour of business finance. We covered so much ground, and I think what's really striking is how interconnected all these concepts are.
Definitely. They're not isolated tools. They all influence each other, and they all impact the businesses we interact with every day.
Exactly. So next time you hear about a company making a big move, think about these financial concepts. Debt, equity, leasing, limited liability, mortgages, they're all part of the story.
And the beauty is you don't need to be a financial whiz to understand the basics. A little curiosity goes a long way.
So true. Thanks for joining us on this deep dive. And who knows, maybe it's inspired you to do some exploring of your own. There's a whole world of fascinating business stories out there just waiting to be uncovered.